the roaring 2020s, and I give that a 55% subjective probability, then 25% to a 1990 scenario, which is a melt up, melt down scenario, because the Fed eases too much and there's too much irrational exuberance. So 80% that the stock market's going higher. And then the remaining 20% is sort of my bucket for everything that could go wrong.
Hi, welcome to Wealthion. I'm James Conner. Well, here we are in the last few weeks of the year. I don't know where this year went, but one of the things I always like to do as we head into a new year, I like to set out some financial goals. And if you would like to have a discussion with a financial advisor about some financial goal setting for the new year, go to wealthion.com/free to speak with a financial advisor. Once again, that's wealthion.com/free. Now let's get on with the show. Ed, thank you very much for joining us today. How are things in Long Island?
Just wonderful. We've had a great fall, and hopefully we won't have too bad a winter.
Well, I am in Toronto, and we have the same sort of weather here. It's just been an amazing fall. But then again, I'm a skier, so I don't mind having a little bit of snow.
Okay.
So the last time we spoke, I can't believe the first time we spoke was a year ago. And at that time, you were very bullish on the economy and also the markets. And this is also at a time when a lot of people were calling for a recession in early 2024, but you weren't. You were very bullish. Your target on the S&P at that time was 6,000. And here we are a year later, and you pretty well nailed it. The S&P is at 6,000, give or take. And so great call by you. But what's your target for 2025?
More of the same, but maybe a little bit more volatility. I'm sure there'll be a roller coaster ride going into the new year. We have a new administration. Donald Trump's, or Trump 2.0, as people are calling it, is what we're looking at. We've had some experience with President Trump during Trump 1.0. This time, he seems to have more of a mandate. He seems to be more in command of who he's putting together, a lot of loyalists. So he's going to be really quite effective here. But it's a lot of moving parts with his policies. But, you know, one of the reasons that I've remained optimistic here is I've observed over the years, and I'm amazed by how well the U.S. economy performs despite who's in the White House. And so I was bullish about the outlook for 2025 and maybe the rest of the decade, irrespective of who was going to win the elections. But I'm still pretty optimistic. I think 7,000 now by the end of 2025 is likely, then 8,000 in 2026, and then 10,000 by the end of the decade. As you can probably tell, I'm not too good with numbers, so I'd like to keep them nice and round, so I remembered them. But 7,000 and 8,000, and then by the end of the decade, 10,000.
And you raise a very good point there. It doesn't matter if you're a Republican or a Democrat or who's in the White House. At the end of the day, it all comes down to the men and the women who are going to work every day and providing for their families that makes your country and my country great.
Yeah, I think we often forget the working stiffs, which includes us. We don't really have that much time for politics. Politicians, that's all they do for a living. And the rest of us have to do what we have to do with our jobs, try to make ourselves more productive, increase the value of our work, our businesses, for the good of our families and our country, communities and country. And we do that despite our politicians. And when we do that, we have to factor in that they exist and that they have certainly have an impact on what we do. But somehow or other, we continue to do it despite their meddling. And a lot of their meddling is counterproductive. It's really not helpful to conducting our chores. But again, we allow for that and we overcome it.
So let's spend a little more time on politics. And as you mentioned, Trump and the Republicans, they won by a landslide. They took the House, they took Congress, they took the Senate.
Yep.
And so you mentioned that you're expecting some volatility this year, and I'm wondering why. And also because the Republicans took the White House and also the Congress and Senate, what does this mean for your expectations for the year?
Well, there's so many policy proposals that with many of them likely to get enacted pretty quickly. So there's, on the happy side, what the stock market liked once it was clear Trump won is the promise to cut corporate taxes from 21% to 15%. That's a big deal. And then for the consumer, he promised that there'd be no taxes on tips, that there'd be no taxes on overtime pay or on Social Security. That's a big deal for a lot of lower income consumers. So that's important. And overall, those two should be positive for the economy. Then on the other hand, he's got the policies of that would possibly increase the deficit, which would be the tax cuts. And he's also got policies that would increase tariffs, which could increase inflation. So, the initial reaction from the stock market was positive, and the initial reaction for the bond market was not so much. But it's a moving story here. It's a dynamic story, and now we have a new Treasury Secretary that's been nominated, and this fellow seems to be relatively conservative in terms of how much he wants to see the president implement. But let's face it, we've seen Donald Trump before, and at the end of the day, it's going to be all about what he thinks, not so much by what his policymakers think. But the volatility in the market could depend on how these things pass. They all going to be implemented all in one shot. I mean, from the get-go, tariffs are easy to apparently implement with executive order. And so that'll be the first thing. And stock market may not be too happy with that initially. And then all of a sudden we get tax cuts and the market might like that. So it could be a pretty bumpy ride here. But at the end of the day, I think the U.S. economy is resilient. It's proven that over the past 3 years. James, as you know, we've had this most widely anticipated recession of all times. It never happened. It was the Godot recession, the no-show recession, and the economy demonstrated that it could deal with a major tightening of monetary policy without having a recession. That was quite an accomplishment. That's something we anticipated, but have to admit, even we're kind of surprised by how well the economy has performed. And maybe that'll continue to be the case through thick and thin. The economy does well. There's been so many roadblocks, so many hurdles over the past 3 years, and yet here we are at record highs in the stock market.
I might have to use that term, the no-show recession.
Yeah.
So you touched on tariffs, and a big component of Trump's economic plan is to use tariffs as a proverbial stick. Yeah. And he recently announced that he's going to impose a further 10% tariff on China and a 25% tariff on Canada and Mexico. Yeah. What are your thoughts on this? And maybe you can just give me your views on what you think of tariffs overall.
Yeah, well, we're not going to know exactly what's going to happen. I mean, I'm a little confused because the last I recall, Trump was talking about 60% on China. So what is he talking now? Is he talking about 10%? Now, the actual tariffs on China right now already are 30%. So it's not as though, Trump 1.0 actually survived Biden in terms of the tariff policies vis-a-vis China. But now he's, clearly getting the attention of Canadians and Mexicans by threatening to raise the tariff to 25%, basically throwing out the treaty that was reworked during Trump 1.0 between Mexico, the United States, and Canada on free trade. And so whatever was worked out back then is kind of being thrown up in the air. And now Trump's using tariffs as a very powerful negotiating team with our northern and southern neighbors, and saying, it's not just about trade; it's also about immigration. And so, it's a tall order, and it certainly is going to require policymakers in Canada and Mexico to respond and to find some way to compromise with Trump, if there's a way to compromise, or at least work out some sort of deal where the punishment of 25% tariffs is put on hold and just kind of continue to held over the heads of Mexicans and Canadians. But I'm not a big fan of tariffs. I think most economists are not big believers in tariffs. Much rather have free trade, but as we know, that's in many ways a utopian delusion of economists that we can have free trade, or that the World Trade Organization has created a world with freer trade. I mean, when China was brought into the World Trade Organization on December 11th, 2001, I should say, everybody expected that the Chinese were signing on to the rules of fair play that would almost force them to be more capitalistic. And for a while, they played that game, but along the way, they started to basically cheat on the rules, and it became more and more obvious, and more and more countries became very concerned about the fact that free trade wasn't so free, not when you did business with China. And now, from the point of view of the United States, it's pretty clear that Chinese companies are moving to Mexico, figuring that we're not going to see them do that, and they're just going to kind of truck their stuff up the back door, and it's going to show up here with our tariffs with Mexico rather than tariffs with China. And obviously, that's not going to that's not going to play out very well, not with this administration. I think history shows that tariffs can lead to tariff wars, to trade wars, and that trade wars are bad for everybody. But sometimes these things kind of build on themselves. Everybody knows they're bad, but it becomes sort of a tit for tat. And before you know it, you've really taken an axe to world trade. Of course, the big example we're all familiar with is the Smoot-Hawley tariff of May 1930. That's really what caused the Great Depression. That's really what shut off world trade, when everybody retaliated to the U.S. Tariff, and global economic activity took a dive. So the experience with tariffs is not a happy one, but they've been around for a while, and countries do use them, and Trump certainly uses them for negotiating purposes. But he's also now aiming to raise revenues with it. Kind of going back to the 1800s, America, the good old days when there was no income tax, and the government raised revenues by putting a customs duty on imports. So I think he's trying to go back to that, and it could raise some revenues, but it could also be counterproductive to the extent that it depresses our imports and depresses global economic activity.
Yes, I'm looking forward to how the Trump administration deals with our Prime Minister Trudeau in the coming months. Should be quite entertaining.
How should we? I guess the delicate way to say it's oil and vinegar. I mean, they're not going to mix very well.
Yeah, I would agree with that. Okay, so you touched on Trump's appointment for Treasury, and that's Scott Bessent. And he has put forth this, what he's calling a 3-3-3 plan, okay, or an economic agenda. And that's 3% economic growth, a 3% deficit of GDP, and he wants to increase oil production by 3 million barrels a day. Right. What are your thoughts on this plan? Any concerns?
It's a clever marketing, tool here to have this three arrows. He borrowed it from Japan's prime minister a few years ago. It definitely highlights the goal here. The goal is to get better economic growth. Who wouldn't want to get better economic growth? And certainly it's possible. The tax cuts certainly could help. But, I think the economy is already on course to grow at a faster pace because productivity has been making a comeback. The labor shortages have caused companies to use technology to increase productivity. And the technologies that are available now lend themselves to doing that to a whole host of different kind of businesses. So I think that was kind of in the works. I was talking about the roaring 2020s back at the beginning of the decade, and I made no assumptions about who was going to be running the White House. I just was focusing on technology and the impact on productivity and growth. And that, of course, has implications for inflation. So I think 3% growth is actually going to be pretty easy to get in the kind of environment I see without the administration having to do much. And if they cut taxes and they provide deregulation, that would help growth even more because it would probably fuel more productivity. So I think that's achievable. And then 3% ratio of the deficit to GDP, that's going to take a while. That's not going to be an overnight thing. Right now, I think we're at 6%. So there's going to have to be, better growth will help some, but there's got to be some slowing down of the pace of outlays and some increase in the pace of revenues. And I think Trump has managed to buy some time with the bond market by suggesting that Elon and Vivek are going to be running DOGE, the Department of Government Efficiency, and that they'll find some substantial savings and ways to cut. Trump clearly wants to go after the bureaucracy, and the bureaucracy employs, I guess the federal government employs 3 million people, so it's actually not as big as people imagine, but they certainly oversee a lot of spending. But cutting that spending, even Elon may find this a Herculean job. It's one thing to run a company and tell people you want to cut costs and then fire people who don't do that properly. It's a whole different story in the government. So we'll see how that one plays out. But I think you notice that the Treasury nominee didn't say when he expected to get this ratio down. I'm sure he didn't mean that it would be done by next year. Maybe he was implying that we get it done by the end of the 4 years. So, which would be a good thing. I mean, it'd be better than going the other way. And then 3 million barrels per day. It's a good goal, and the idea is to make the United States even more energy independent and more of a key factor in global energy supply. And the problem is it'll depress energy prices, which then takes some of the incentive out of producing more oil. But I have been noticing that the energy sector is probably one of the most efficient sectors in America and maybe in Canada and other places. Particularly the oil drillers and frackers are always coming up with new ways of getting more oil out of the same well, and they've been very successful at that. And they've been successful lowering the cost of production, so maybe the price of oil can come down and they could still make a profit at that lower level. And then, of course, natural gas is a big part of a story. Now we're going to be producing more LNG export facilities and exporting more. And initially, that might actually raise LNG prices in the U.S. because right now, all that gas is literally bottled up in the United States under the export limitations. But we have a lot of natural gas, and I think it's going to. I think if we look at more energy production, including gas and oil, I think it's very feasible.
So there's a couple of things I want to unpack there. First of all, when you take the deficit from 6% down to 3% and you're cutting taxes at the same time, how do you think they're going to decrease the deficit by that much? Yeah. Because you'd have to make some drastic expenditure cuts.
Yeah, I don't know how they juggle these balls. It's not just 3 balls; it's quite a few more because all their policies. It's kind of like when the doctor prescribes the medication and the doctor says, "Wait, before I do that, let me check your record here to see if there's any interactions." We're not checking the interactions. We got all these medicines to make the economy better, and we're not really sure how they will interact. I mean, will tariffs cause a trade war and deflation? Will tariffs lead to inflation? Will tariffs generate enough revenues so we can cut taxes without increasing the deficit? And if it just kind of covers what we need to pay for the tax cuts, then what are we actually doing to reduce the deficit? So there's, I think a lot of it is policies that sound right, that makes sense if they work, but some of them have, like medications, have adverse consequences, and that's why it's going to be a volatile Europe ahead here. I think, on balance, the U.S. economy is a healthy patient. and maybe it's got a few areas where it could use a little bit of medication, pick me up or whatever you want to call it. But all in all, I think the U.S. economy is just going to be buffeted around by these policies, but still prove resilient and move forward.
The price of oil's been hanging around $70 for a good part of the year, and this is in spite of what's happening in the Middle East and also Ukraine. And I almost get the sense that if we didn't have these hostilities going on, oil would be a lot lower, $60 a barrel, maybe $50 a barrel. I don't know. But what are your thoughts? Do you think it's at this level just because of a slowdown in the U.S. economy or the global economy?
Well, I think the most important explanation for the weakness in oil on the demand side is China's weak. China's property bubble burst. We know from what happened in Japan in the 80s and the United States in the 2000s that once the property bubble bursts, it takes several years for it to no longer have an adverse consequence on economic growth. And I would argue that the Chinese housing bubble is probably the biggest housing bubble of all times. And so that being the case, I think that's depressing the Chinese economy. The one-child policy of the Communist Party has come back to haunt them. They've got a geriatric demographic profile, which is clearly not stimulative to consumption. Consumers have a negative wealth effect from home prices being down and from the stock market being down. Now, of course, they are doing their best to try to stimulate things, but I think they would have to do something pretty radical, kind of like what we did here in the U.S. During the pandemic, and that's actually send people checks to have them spend it. Without the consumer actually increasing their spending, I don't know that the Chinese economy really is going to perk up. And the other thing is, with regards to energy, is they're driving a lot of electric vehicles. I mean, that's one country where I think the electric vehicle push really is turning out to be a big deal. And that being the case, that reduces the demand for oil. It doesn't reduce the demand for energy, but they're building more and more power plants, and they're building their electrical power grid to handle all that. Now, of course, they're doing some of that, maybe a lot of it, with coal-fired plants, so that kind of counters what the world is trying to do in terms of reducing the amount of carbon in the air. But that's what they're doing. India is doing very well, but I haven't been to India, but I'm told the traffic is horrible. So I got to believe they're burning up a lot of gasoline. But then again, they're not getting very far. So India just hasn't been the kind of growth market for energy the way China has been, and Europe is a mess. I mean, it's got a lot of problems, and their economy is kind of bumping along, struggling along. So that's the demand side. The U.S. is doing fine. We're driving. Gasoline consumption is relatively high. We're also buying electric vehicles. But on the supply side, there's just a lot of oil. And it's the Russian oil is getting out one way or the other, and probably being sold to China and India. And the United States, despite Biden saying that he's against fossil fuels, we're producing at 13 million barrels per day in the oil fields, which is basically a record high because of the productivity of the oil industry. So you put it all together, and it's hard to see much, if any, upside here. And even with the geopolitical crisis, as you mentioned, we haven't been able to get the price up at all, really. And so now there's talk that Hezbollah and Israel are going to have a ceasefire, and maybe that'll start to calm things down. But, we still have the issue to resolve between Israel and Iran, and that may still involve a military confrontation between the two of them.
And the higher oil production will definitely be good for inflation. But what about these tax cuts and also deregulation? Can that not be construed as being inflationary? Do you see any risk of inflation heating up here in 2025?
Yeah, I wouldn't think deregulation would be an issue on the inflation side, because presumably that would cut the costs of doing business, and in a competitive marketplace, which we still have. we should be able to see some of that actually pass through and keep a lid on inflation. Tax cuts might be inflationary if they stimulate a lot of demand. But overall, I think fiscal policy is not going to be any more stimulative than it has been during the Biden years. I think it was the spending during the Biden years that really kicked up inflation. That wasn't the only explanation. I mean, the pandemic caused a lot of supply chain disruptions that took a while to abate. But I think on the inflation front, again, it may be a bumpy road, but all in all, I think the outlook for energy suggests that that's not going to be a major source of inflation. The global demography, a lot of countries are experiencing aging demographics, and I think those kind of societies tend to consume less, and the people drive less as they get older. So I think that may be a disinflationary force. And then productivity. I think that we don't fully appreciate the fact that the future is here. It wasn't too long ago, at least in my memory, I can still remember 2020 or 2021. And, back then, if we talked about 2025, it's like, whoa, that's the future. And here we are in 2025. And there are a lot of aspects of, our society that fiction books on, science fiction books anticipated. And we're on the cusp of seeing humanoids that are really quite capable of working, increasing the productivity of the labor force. We're seeing the potential here for the AI technology, which is not revolutionary, it's evolutionary. I think we have to put AI in the context of data processing. Data processing is something that goes back to the abacus, of course. But true data processing really got going, I think, with the IBM mainframe in the 50s and 60s, and that evolved in the 90s into the PCs, and then the following decade we had the cloud. And so it's kind of a one thing after another on data processing. And the name of the game is to process as much data as fast as you possibly can. And that's what AI is sort of the latest generation of. It's a process of taking what people call big data, just an enormous amount of data, and processing it to make sense of it, to use it to increase productivity, to work more efficiently with marketing and consumers. And that's what this is all about. So you combine NVIDIA chips, and Elon Musk is talking about buying 100,000 NVIDIA chips. He's raising $6 billion. So he wants to build a super duper computer to stuff all this data into it and come up with autonomous driving vehicles with more productive and useful humanoid robots with space technologies. And so he's not the only one doing it, of course. And these things are no longer pie in the sky. They're going to be increasingly affecting our lives over the next several years. And I think they'll increase productivity. And, technology, once it really takes off, it really takes off. The technology really didn't take off in the 1990s. Once everybody had a Dell box with IBM Word and Excel, we got a certain amount of applications that you could use with that, but it didn't lend itself to a whole host of businesses. Now we have technologies that are very powerful, very cheap, very easy to implement, very easy to update, that I think will have a tremendous impact on our lives over the next 5 to 10 years.
Interesting points. So when we spoke a year ago, I want to talk about the Fed now, but when we spoke a year ago, there was individuals out there calling for 6 cuts in 2024. And we've had 2 cuts. We got 50 in September. We had another 25 in November. We have one more Fed meeting coming up before the year end. What do you think they do?
Well, I didn't buy into the multi cuts in the Fed funds rate at the beginning of this year. And you're right, the people were talking about 6 to 7 rate cuts this year. And then we got closer to the fall, and people were talking about 25 basis points at the September 18th meeting. And we kind of caved in and said, okay, they're going to, they're not listening to us. The economy doesn't need it. Inflation is moderating. The economy is strong. The Fed doesn't really need to cut rates. Rates are actually probably where they should be. But they just wouldn't listen to me, and instead went their own way. And not only did they cut, but they cut by 50 rather than 25 basis points. And my reaction was, watch the bond yield go the other way. And that's exactly what happened. The bond yield went up like 75 basis points after that meeting. And then they went down 75 basis points all told so far this year by cutting by another 25 in November. They believe that the Fed funds rate is restrictive. And I said, well, wait a second. They're supposed to be data dependent. And I'm looking at the same data as they are. And I'm saying the unemployment rate's just about 4%. Inflation is about 2%. I mean, aren't we there? I mean, it's like the kids, you take a long drive and the kids are in the back seat saying, are we there yet? Well, we're there. We're at nirvana. We're supposed to be. And somehow they think that these rates are too high. But the economy has demonstrated that it could do just fine with this level of interest rates. So I'm not convinced that they really have to lower interest rates much more. I think they've sort of started to back off and say, well, we're still lowering rates, but maybe more gradually, which is fine. I mean, if they want to do it slowly and see how the economy is responding, they were going to do that anyways. But I think interest rates have normalized. 4 to 5% bond yield is kind of where we were before the great financial crisis, before all the abnormality was zero interest rates. It's not a Fed funds rate of 4.75%. It's not a bond yield of 4.25%.
And I'm glad you brought up yields, because the 10-year, it's been quite volatile here in the last few months. I think it's gone from a low of 360 up to maybe 440, give or take.
450, yeah. 440.
So what's that telling us?
I think I coined the phrase bond vigilantes back in 1981, and it's telling us that the bond vigilantes aren't happy. They're concerned that the Fed is tightening too much too soon. They're concerned that with the economy doing this well, that the Fed may be stimulating an economy that really doesn't need to be stimulated, and that could perk up inflation. And while the Fed may be very comfortable that wait a few more months and inflation will be down to 2.0%, which is what their target has been all along. And it was all along, they were very adamant, 2.0%, not to 2.1, 2.2. They wanted a 2%, and they wanted it to be there for a while so that they gain confidence that that's the case. But they stopped talking about that. Instead, they said, we're close enough, and we want to make sure the unemployment rate doesn't go up, so we're going to lower rates. But there's some sticky areas still in the inflation area. Rent inflation has actually started to pick up a little bit, and everybody, including ourselves, thought it would continue to moderate over time. But now it's not quite working out that way. And there are some areas in the country where rent inflation actually is starting to pick up. So that's a concern. I guess the problem is, homes are so expensive that people just can't afford them, and they're being forced to continue to rent. And there's still a shortage of homes relative to the potential demand. And then, of course, there's what Powell himself called super core inflation, which is services inflation, taking out energy and taking out housing. And that's still stuck around 3 to 4%. It's not at 2%. He made a big deal about it being sticky and too high about a year and a half ago. So the bond market remembers all that, and the bond market, doesn't want to have uncertainty about the Fed's commitment to bringing inflation down to 2%. So I think that's what we're seeing in the bond market is the bond vigilantes threatening to saddle up and take law and order into their own hands by pushing bond yields up to slow the economy down, to slow inflation down, if the Fed gets too sloppy here and too easy.
So just to summarize a lot of the points you just said, you think the economy is going to continue to hum along at 3 to 4%.
Yep.
You see the S&P going higher throughout 2025. It's going to be choppy, but it's still going higher.
Yep.
And you see no risk of inflation heating up and no risk of a pullback or a recession.
Correct. And that's, look, I try to be reasonable about these things. That's my base case. I'm not going to tell you things can't go wrong, and they can go wrong in a bullish, even more bullish direction for the stock market, and a more bearish one. So I've been talking about three scenarios. I've been talking about the roaring 2020s, which is the base case you just kind of outlined just now, and I give that a 55% subjective probability. Then 25% to a 1990 scenario, which is a melt up, melt down scenario, because the Fed eases too much and there's too much irrational exuberance. So 80% that the stock market's going higher, and in one case it's going to go higher without a lot of things going straight up and straight down the way they did in the 1990s. And then the remaining 20% is sort of my bucket for everything that could go wrong. Initially, it included mostly geopolitical risk, which seems to have actually not been an issue so far. I mean, it's not as though things aren't still awful between Ukraine and Russia and in the Middle East, but they don't seem to have much of an impact on the global economy, and certainly not on the U.S. economy. And then I threw into that bucket because a lot of people have been asking me, what about a potential debt crisis? And so you have to put that in there. But I think, as I said before, Trump might have bought some time on a debt crisis by promising to have a look at ways to cut spending, ways to raise revenues. So we'll see how that all shakes out. And so that's the way I'm looking at the world.
Okay, so let's talk about the stock market now. And you mentioned this concept of irrational exuberance. And I think we see a lot of it going on right now. When you look at this year in the S&P, it's up 25% on the year, give or take. But you have a lot of individual stocks, like I'm going to say MicroStrategy. It's up 500% on the year. Palantir is up 250%. NVIDIA is up 200%. Like, these moves are just astonishing. And then just recently, I'm sure you saw this individual, his name was Justin Sun, just paid $6 million for a piece of art, which was essentially a banana taped to the wall.
Yeah.
Duct tape to the wall.
Yeah.
But when you see things like that, these moves, and also this piece of art going for $6 million, does that not concern you a little bit that we might be in a period of irrational exuberance?
James, it concerns me a lot. It concerns me that I picked the wrong career. I should be an artist and just tape a banana to the wall and get $6 million for that. That's pretty sweet if you can do something like that. And I think you forgot to mention Bitcoin. Bitcoin's also been kind of that vertical ascent we've seen in some areas of the marketplace. So, the irrational exuberance, aspects of irrational exuberance are certainly there. Interestingly, though, of late, the market seems to be broadening out, the stock market, to mid caps, the small and mid cap stocks. And there's no irrational exuberance there. That's quite the opposite. They've been really cheap for a long time, but irrational exuberance could lead them to be overvalued pretty quickly. We see some pretty remarkable moves in a very short period of time. So I am starting to see a little bit too much bullish sentiment, and so I may have to reconsider the subjective probabilities that I assign to kind of a civil bull market that carries us through the end of the decade without any major drama, and reconsider the potential for a 1990s kind of melt up, because there are aspects of it. But some of these areas where we were seeing the market, the big moves to the upside, they're kind of justified by earnings. I mean, NVIDIA certainly looks like it's still justified by earnings, and its growth rate is what is it now? Only doubled over the past year, so that's a little bit disconcerting, I suppose. But yeah, I mean, the bottom line is there's irrational exuberance is here in some areas for sure.
You mentioned earlier that, or a few years ago, you've actually coined this decade as the Roaring Twenties, just like the 1920s.
Yeah.
and we all know how the 1920s
Yeah.
ended, right? But makes me think of that book. I'm sure you read it by Charles Mackay, The Madness of Crowds.
Yeah. Well, I think you're making a really good point, and that is, history is relevant, and it doesn't repeat itself, but it rhymes. And in this case, I've been thinking that what causes recessions and bear markets is tight monetary policy. So we had that, and we actually, as we noted earlier in our conversation, I've been kind of pushing against that. I would say, you know what, the surprise this time is going to be that monetary policy doesn't cause a recession because the credit system is more resilient, the economy is more resilient, consumers more resilient. I made a lot of arguments which are more specific of why I thought the economy would handle it. So, all right, so let's move on. What else could cause a recession? Well, oil prices soaring, shortage of oil. We're all waiting in gasoline lines, not able to enjoy our lives, go on with our lives. And so here we had the geopolitical crisis, and the price of oil's down, and there's plenty of oil around. Okay, so that didn't cause a recession. So what's left? Well, as you said, the 1920s ended very badly, and I think we all know, there's no debate, that one of the main reasons that it did was because of the Smoot-Hawley Tariff, which was passed in May of 1930, and that shut off world trade. So I guess we can say, if we can't find any recent reason for why this economy should have been in a recession, well, we got a new one here, which is an old one, and that's tariffs. And if we get tariff wars, then we very well could see a global recession. So it's a very good point, and it does make the 1920s relevant as history, because while it was a lot of fun for a while, it's when the government implemented this horrendous tariff and policy that things started to really fall apart. It wasn't really the speculative excesses in the market. It was a recession, a depression caused by the Smoot-Hawley Tariff. So I would put that certainly in the bucket of what could go wrong. Geopolitics is still in there, but maybe it's less of an issue. And the debt crisis is still in there, but again, maybe it's less of an immediate issue. And then all of a sudden, because of Trump winning, we got tariffs in there, and it's more of an issue.
So I was going to end our conversation by asking you how, or what you suggest how investors are going to make money in 2025, but it sounds like the answer is very simple: just stay long.
For now, just stay long. It's hard for me to recommend to somebody who's been in cash all this time to jump into the market. I've been bullish on this market since late October 2022, so we got that bottom pretty well nailed. There was a lot of cheap stocks back then, and now not so much. The valuation multiples are extended, but a lot of the S&P 493, the S&P 500 taking out the mega cap 7. I think there's still opportunities in that area, in technology, in financials, in industrials, and communication services. We think healthcare, we think, is going to continue to be an issue here with, Bobby Kennedy. We'll see how he and Dr. Oz, what they do to the healthcare industry. Materials and energy, it's hard to get excited about them when China is kind of muddling along. Gold has had a big run. I think it may continue to move higher, but I'm just not the right guy to come to talking about gold or Bitcoin. I'm an old-fashioned strategist. I need income. I need dividends. I need interest income. I need rents. I need something I can value. And when it comes to Bitcoin and gold, I think it's really has more to do with mob psychology. How do people feel about things? And gold has actually been held back by Bitcoin because Bitcoin's a lot more exciting than gold. But Bitcoin, who knows? I mean, there's no way to value it, and that market's open 24/7, and the potential buyers are everybody on the planet Earth. Whereas, I think it is a speculative bubble. And by saying that, the conclusion is going to burst. But before everybody starts, putting out all these nasty comments about how I'm ignorant about Bitcoin, let me just say that I am saying it could go to 1 million. So, and then ask me again, in which case I'd say, well, I guess I missed it to the million. And then I am scratching my head and asking myself, what could possibly burst this bubble? And maybe I'm just missing something here. And I have been getting feedback on that issue. So I'm open to learning about it. But again, I'm more focused on stocks and bonds and commodities and real estate assets that I have more familiarity with.
I'm very similar to you in terms of my investment approach, very conservative, and but I always have an allocation toward gold, and I thought gold was doing quite well this year, up 30%, give or take. But meanwhile, Bitcoin is up. It moves so fast, I can't remember. It's up over 100% on the year, right? So
it's great.
So, and I think last year was up 150%. So even though I never play it, I have the utmost respect for people that do play it.
Absolutely,
and making money from it. So that was a great discussion, Ed, and I want to thank you very much for spending time with us today.
Sure.
If somebody wants to follow you online or learn about your services, where can they go?
Yeah, a couple of years ago, we created a service for individual investors, and it's called Yardeni, Yardeni, quicktakes.com, YardeniQuicktakes.com. Have a look and give it a try.
I'm a subscriber, by the way.
Good.
Ed, once again, thank you.
Thank you.
Well, I hope you enjoyed that discussion with Ed Yardeni, and maybe in a year from now, when we have another chat with him, the S&P will be at 7,000, which would be quite a move. 2025 is just around the corner, and if you've been neglecting your finances because you're too busy or you don't have time, consider having a discussion with a vetted financial advisor at Wealthion.com/free. It will only take a few minutes of your time to fill out some information. There's no obligation whatsoever to work with any of these advisors. It's a free service that Wealthion offers to anyone who has an interest. Once again, you can find out more information at Wealthion.com/free. Thank you for joining us today. And if you want to check out some more content on Wealthion, check out this video now.